I'm going to jump around rather than going, because it's one of the ways to help keep you focused on the panel is to not have you expect that I go from each panelist in a row. I'm going to jump around a bit just to keep you awake. By the way, I just also want to interject that I am a little bit out of date. The alphabet soup has a new member, which is CMU. That's new since I was last in Brussels. So I have to add that one. Jacques, regulatory complexity. I mean, it's not a new it's not a new thing. No, it's been around for a while. But how?
It's not new. It's not European. The Americans have a very complex set of regulation. I was told that the Volcker rule, I think, is 1,000 pages. So we're all complex because the reality is complex, and because the regulator wants to deal with all the cases that are, possible. Which I think is a mistake. I think regulation should be very simple, principle-based, and that the execution, the implementation should be verified by supervisors in a coordinated way. So that would be my answer to complexity. I'm just going to give you one example that came out last week. There is an interesting study by Harvard Kennedy School that came out last week. And it shows how community banks, which are small banks, local banks in the US, have been affected by complexity. It's very interesting. Those banks did not have major problems during the crisis or before the crisis. They were okay. They do basically agricultural loans and SME loans. They don't do derivatives. And the fact of the matter is that they are disappearing. There were 11,000 of them before the crisis. Now they are 6,000. And why have they disappeared? Why are they reducing? Because of complexity. They explain that hiring 2 officers in terms of checking compliance reduces the profitability of those typical community bank by 45 basis points, and it follows that 1/3 of these typical banks have to close down because of their unprofitability of a regulatory nature. Now, you could say it's not serious because the jobs that these banks used to perform have been picked up by those banks which have, in a way, filled the holes, filled the void created by this consolidation process. Well, that is not exact. In agricultural terms, there is no appetite by big banks to get into that business. And for SME lending, it's not very clear. So there is a déperdition, there is a loss. And I think you should be reading this fascinating study, very academic, very based on a lot of facts. It's interesting. And it shows that the vitality of community banks has been put in jeopardy, not before the crisis, not during the crisis, but after the regulation. Interesting.
So that's one clear effect of complexity of regulation. Howard, as a former regulator yourself, regulatory complexity, you'd be well qualified to understand what that means. What has been the most damaging effect so far since 2008 of regulatory complexity that you can see as we look across Europe?
That's a difficult question. So as I collect my thoughts, let me thank the Swiss Finance Council for inviting me to do this. I thought it was a rather good idea, and given that we spend most of our time talking about gloomy things like Grexit and Brexit, probably more likely the second one, that it's nice to focus on something forward-looking. I interpret this, by the way, from Axel and Urs as being the first shot in the battle for Swentry. I'll leave you to think about that new acronym. Regulatory complexity, I think it's easy, hands up who's in favor of regulatory complexity. So this is an easy thing to attack. I'm astonished, really, that Erst thinks it's complicated, because actually at Erst, once you've got your Basel III with your core tier 1 and, of course, your countercyclical buffer, and then you've done your liquidity coverage ratio and your stress test and your reverse stress test, and then you've done your CCAR and your supplementary leverage ratio in the US, and, of course, your GSIB buffers, then, the thing seems to me to be pretty straightforward. I don't quite...
Then I get a call from Andrew Bailey.
Yeah.
Can I just say, I hope somebody posts this to YouTube, because this will get millions of hits. That is worth turning into a rap song as well.
Yes. He forgot the PRA, which you then call, right?
I would make 3 points. One, I think that there will be a point, it's probably not quite now, but there will be a point when a global exercise, presumably led, I think, by the FSB, Financial Stability Board, to attempt to look at the whole of banking regulation and to say, have we created a monster, and are there bits that we could remove? I think there will be a moment when the climate is right for such a thing. I think in the meantime, the bits that worry me the most are the bits that point in opposite directions. For example, the whole more sophisticated approach to risk-weighted assets, which I think is in principle correct, and quite clearly before the crisis, banks did not properly ascribe capital to certain highly risky positions. That whole effort to have a more risk-sensitive approach to your assets actually conflicts at certain points with a leverage ratio approach. And you are actually in the cross-eyed controller position, where you're told to reduce your risk-weighted assets here because the capital charge is rising. But then, the supplementary leverage ratio tells you something else. And so I think we really need to work on these difficult ones where there is a conflict between the two. The third point, though, that I would make is that I find it very hard to see who is looking at the impact of regulation in the round. So the Capital Markets Union, for example, terrific. Hands up who's against that. But it's rather odd that we've had a period since 2008 where we've been ratcheting up capital on the banks in Europe. And hey, what a surprise, that means that credit availability has been somewhat reduced. At the same time, we've had Solvency II, which is restricting the ability of insurance companies and pension funds to invest in risky assets. So, hey, we're a bit short of equity capital. And then suddenly, 7 years later, we say, bloody hell, we better do something about this Capital Markets Union, because we now seem to have constrained. Now, this is pretty odd, really. So I'm not against the Capital Markets Union project, though we can come on and talk a bit about the detail if you like. But what I do find alarming is that there hasn't been an attempt to look at all this in the round. In theory, after the crisis, we set up the European Systemic Risk Board, which perhaps should have been doing this. I'm not quite sure whether it has done that. I don't believe it has quite. Maybe we need another body. I was attracted by, you said that we were living in an echo chamber. I don't know what that is actually. Is that related to ECOFIN? But maybe the echo chamber should be set up actually, and that would look at these things in the round. So my plea would be to look at the impact of the different regulatory things in the round to see if we are over-specifying the system in the light of the kind of financial markets that we want to see.